let's talk about picking stocks, a hobby more expensive and pointless than golf, kind of. Welcome to Call Them on Their Bull, where I take down the internet's worst investing advice. I'm Amanda, you may know me as the dumpster doggy over on the socials. And in this YouTube series, I take a tough investigative look at why Brad and Chad do it so bad but are still rich thanks to their dad. And this time, I'm talking about the bros that tell you that you're not a real investor unless you buy individual stocks, or engage in stock picking as it's more generally known. Right? Like everybody has some Elon fanboy in their life telling you to put it all in Tesla stock, or in this hot new virtual reality company, or in pot stocks, or even in themed strip clubs. Yes, that's a real thing. It's called Rick stock. Old Uncle Eddie won't shut the fuck up about it because he loves to argue that lap dances are recession proof. Thanks for the hot tip, bud. But unfortunately for the shareholders of Tootsie's Cabaret, stock picking usually doesn't work that well. On balance, it leaves investors worse off. Now, before I explain why, let's briefly review the two overarching strategy methodologies for investing in the stock market. There's active management and there's passive management. Active management means actively trying to pick the investments that you think will perform best. This active picking could be done by you or by a professional. And yes, individual stock picking is active management. Passive management is when you invest across some entire market, like the entire US stock market, usually using an index fund. Again, you are investing in that market as a whole. And by the way, robo-advisors are usually utilizing passive management by buying you a portfolio of index funds. The idea with passive management is that we cannot control the market necessarily. We can only hope to capture whatever it ultimately provides. And so passive management is definitely the easiest way to invest, but historically, it has also been the most profitable way to invest. You can think of passive investing like it's a pot of slow cooker chicken noodle soup. You just set it and forget it. All those ingredients are thrown in there, and then that shit just cooks itself. So why do people choose active management, aka stock picking, instead? One, they're trying to beat the market, and specifically the average performance of all stocks in a market like the US stock market, something that is very easily achieved by purchasing an index fund. They're hoping to find that one stock that might be the next Apple that makes them rich for life. Two, the second reason is because they really enjoy it, or it just gives them something to do. They're bored. In fact, there's an entire online culture that is built around this activity. Take the popular Reddit forum Wall Street Bets, for instance. Every day, there's a vibrant, intelligent discussion happening there from some of the greatest minds in the nation. Okay, so next I'm gonna read from Wall Street Bets. There's just a couple of things I found perusing today. Only a couple of days ago, you single-digit IQ fucks were talking all kinds of hot shit in the daily thread. Eat rainbow dicks, you gay Fruit Loop wannabe bears. Twerps like him can meet his lips to my dick tip. What if he's into it? He fucking better be. I hate it when they fuck with the vibe. Thanks, Reddit. Beyond greeting your internet comrades with homophobic slurs, the internet allows you to eat, breathe, and sleep the stock market if you so desire. Which you can miss me with the homophobia and the misogyny, but however you get your rocks off, I guess. But the question still remains, even if you find active management entertaining, is it really a smart way to spend your money? Well, let's take a look at the numbers. So every year there are studies on how well active management does versus passive management. And this is generally done by looking at investment funds, because some investment funds, so both mutual funds and exchange traded funds or ETFs, are actively managed by professionals. And then some funds, both mutual funds and ETFs, are passive or index. This gives us a really robust pool of data to look at. And in any given year, the headline is always something like this. This year, 96% of professional active fund managers did worse than the market average. The market average, again, which you can easily capture with an index fund. Imagine being in an industry where the most veteran leaders are wrong more than 90% of the time. Their stock picking intuition is just as good as your "he's the one" intuition from high school. Mine became a priest. In a study of the most recent 10 years, 85% of actively managed US stock market funds underperformed their benchmark, which is the S&P 500. And then after 15 years, nearly 92% do worse than the average. And I cannot stress this enough. These are professionals with every single analysis and forecasting tool at their disposal, which all begs the question, why are these guys so bad at their jobs? Well, because they are in a pretty tricky business, and that is the business of telling the future. There's really no amount of analysis of the existing data that will give you some sort of eye into the unknown. Only Miss Cleo knows. Only Miss Cleo can do that. Right? Like your boyfriend made fun of your roommate for being into astrology. He's doing the exact same thing every day with stocks, trying to predict the future. Robinhood is basically co-star for finance bros. But gender correlated future predicting hobbies aside, there is another reason. The markets are what we call efficient. Now, does everybody agree on this? No, but it's worth understanding. What this means is that the prices of the things that we buy, including but especially stocks in the stock market, they're pretty fucking accurate to their actual value because we are all voting on that value constantly. We vote by buying and selling that thing, that stock, which is the mechanism that shifts the price. So let's say that we're all buying into Rick stock. So we all pile in, we all buy our own Rick stock. That then increases the demand of Rick stock, which pushes the price higher. And then maybe we hear that Rick is stealing all of his tips from his dancers. And so we all decide to sell out of Rick stock. We all bail, we all sell, that drops the demand, and that is what drops the price lower. And so if millions of investors and billions of dollars are constantly rearranging into different stocks as the world around us is changing, the result is actually a thing that is pretty dang accurate, or as we say in finance, efficient. Another way that we say this is that prices reflect all known information. If it exists, it is priced into the market already. And so when you are attempting to pick stocks that will do better than the average, you're essentially saying, I know something that everybody else does not. I know more than the entire global investing public. And that's like saying that you know more about spandex than Richard Simmons. You don't. And no one really does. It's just that sometimes people get lucky. But here's the thing, nailing one drunk karaoke solo does not make you Katy Perry. And what we see is that these active managers aren't even doing as well as the boring old index, and we're not even yet accounting for all of their costs. It costs a lot of money to run an active management business, right? They are going to be charging you transaction charges, management fees, right? Like somebody's got to pay for that high-rise office space in Manhattan, that Viagra blue Porsche, and the side girlfriend's new titties. There are costs. But let me be very, very clear about something. Although beating the market or beating the index might be the stated purpose of active management, the real reason, you want to know the real reason that paid active management exists? It exists as a means of procuring fees from you, from me, from all of us, period. That's why the model exists. And so if professionals can't do it successfully, what do we think are our chances? Now, I want to be very clear. It is possible to beat the market. For example, if you only bought Apple stock 20 years ago, you beat the market average. But when you do this, you are taking a huge risk because for every Apple, there are 10 SeaWorlds. And I even think that saying beating the average sounds a bit misleading because when we hear average, we think that we have a 50-50 shot of beating that average because it seems like what that means is that half of stock's performance does better than the average and then half does worse than the average. But what we actually see happen in the stock market is this. We often have a small number of extreme outperformers that essentially buoy the average. It lifts up the entire average. And depending on the year, the data shows that only 1 out of 6 or 1 out of every 7 stocks is actually an outperformer. The majority of stocks actually tend to do worse than the average. So you don't have a 50-50 shot. You have like a 5% or a 10% or a 15% shot at picking the next big stock. These odds are more along the lines of a 7-Eleven bathroom having toilet paper when it's the only option on a road trip and you've been holding it in for hours. Those odds. Studies have shown us that the more investors try to pick stocks, or even worse, to trade around the market, as is done with day trading, the worse off the outcomes. Why? Well, there are lots of reasons. For starters, the next big stock is not going to be whatever was the last big stock. Remember, with stock picking, you're in the business of predicting the future. And picking what is already done well is one of the most common investor behaviors that we see, especially with retail investors. That's me and you. And it's one of the reasons that retail investors do so terribly. We see the shiny thing, the thing that's already performed well, and we want it. That ship has sailed. But that's not all. Investors tend to jump on trends too late, they bail out when they should be buying in, and just generally exhibit overconfidence and ultimately destructive investing behaviors. Our brains trick us. In fact, and I hate this, but dumb money is a term that was coined and is used to describe when and where retail investors like us put their money. We are dumb money. And get this, Robinhood, which made trading accessible to the masses, is currently under investigation for not disclosing that they sell our dumb data, likely to hedge funds, who then use that information as a contraindicator, which means that whatever we do, they do the opposite. That's how notoriously bad retail investors are. And although this isn't a video about Robinhood, I still think it's worth discussing. So first, understand that Robinhood is just a place where you can buy, sell, and trade investments like stocks, ETFs, and options. And so in this way, it's kind of a blank canvas, and you ultimately paint the picture with your investment decisions, which sounds innocent enough. But my main beef with Robinhood is the intentional gamification of stock trading. And this is done via behavioral nudges, basically using every trick in the Silicon Valley social media playbook in order to get you hooked on the app. Now wait, what's it called when risking your money becomes addictive? Oh, that's right, gambling. But this is a more socially acceptable form of gambling than taking crank after crank at the Sex and the City themed slot machine in Vegas. Now, if Robinhood was a casino, they would be offering free champagne and lobster rolls. But since it's an app, Robinhood uses habit-forming features like frequent notifications, just checking in on you, colorful graphics, free stocks, and one-click trading. Their goal is to keep you on the app as long as possible. And just like you can get addicted to Candy Crush or Instagram, or if you're a boomer in the Midwest, Facebook, you can get addicted to engaging in risky money behavior on Robinhood. We continually see stories about the young and novice engaging in risky trading strategies, like options trading, that they don't even really understand. Options is even riskier than individual stock picking. In fact, the New York Times found that in the first 3 months of 2020, Robinhood users traded 9 times as many stock shares as E-Trade customers and 40 times more shares than Charles Schwab customers. They also bought and sold 88 times as many risky options contracts as Schwab customers. 88 times. Now, unfortunately, our Orwellian app daddies aren't going to draw some moral line at risking some unwitting 18-year-old's paycheck from Zoomies. They don't give a shit. Right? In fact, they might as well be handing packs of cigarettes to preteens. Though Robinhood does make it easy to invest, which is great, the flip side of that is they do not encourage investing best practices like boring, long-term, set it and forget it investing. And the more times you pull that handle on that slot machine, the more Robinhood thrives. Can you use Robinhood to get started? Sure, of course. But know when your investing choices are no better than betting against a casino. In conclusion, should you invest in individual stocks? Again, sure, if you want to. And I'd say the best reasons to invest in individual stocks are this. 1, it's something that you are genuinely interested in doing and learning. 2, this is how you like to spend your fun money. 3, you're actually looking for ways to add risk to your portfolio, which can generate outsized returns, but it is also possible and likely that you end up on the other side of that deal. That said, most people probably don't need to pick or buy individual stocks with any more than maybe 5% or 10% of their overall portfolio. It's just my rule. My brilliant friend Paco de Leon, founder of the Hell Yeah Group, puts it like this. Buying individual stocks is like buying assless chaps. They aren't for everyone, but if you do buy them, they shouldn't be the only pants that you own. Diversify your investments and your pants, kids. And all I ask is that you understand what you're doing and understand all the ways that the human brain can and will sabotage you in the process. Now, for most of us, I hope that this is actually great news. You do not have to spend your Friday nights analyzing data charts and posting on social media about how you never stop grinding in order to be a successful investor. In fact, the cheapest and laziest ways to invest have also historically been the best. So moral of this story, if you want to fuck around with your money, just go to a casino. It's more fun, and at least they have crab rangoon. Hit subscribe and follow along for more Call Them on Their Bull.